Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options. It's a flexible, powerful trading tool. In today's webinar on the effective use of options strategies, we'll take a look at the best and worst case scenarios for a number of common trading strategies. As always, we'll cover the material, as well as your questions, in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of options and investments to our discussion. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. We've added some new questions to the survey and would love to hear your thoughts on time and day for our webinars. As I mentioned, there's a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. If you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And don't forget that the OIC has live events coming this fall to a city near you. Our evening seminar schedule kicks off in Chicago this September and will be followed by similar events in the New York area, Boston, Los Angeles, and the Dallas area. Make sure to check our full schedule at optionseducation.org. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, using option strategies effectively. Joe?
Nick, thanks a lot, and thanks everybody for joining us today. Looking forward to today's presentation. Actually, I love talking about option strategies, and that's what we're going to do today. I've decided to jam in a bunch of them. We've got 11 different strategies we're going to at least touch on over the next 45, 50 minutes or so. So let's get started. As most of you know, there is a document that the industry puts out, Characteristics and Risks of Standardized Options, that speaks about the benefits and risks of the listed options product. Do be sure to get a copy of that before you trade options. You can get that either through your broker or at the OCC. As I've mentioned before, a good 35% of the attendees at our webinars are here for the first time. So I keep a couple of these same slides in about who we are. The OIC is funded by the 12 U.S. listed options exchanges and the OCC, which is the Clearing Corporation. We've existed since 1992 with one mission, and that mission is to go out and educate retail investors, financial advisors, and even pension trustees and other folks on the benefits of risk of the listed options product. One of my favorite slides is this one, and it speaks to the growth in the listed options industry. The industry started in '73 in Chicago. 16 different companies had listed options that first day in 1973. We've got over 4,200 listed products at this point, combination of stocks, indexes, and ETFs. Last year, the industry did just shy of 4.3 billion contracts for the year, and that averaged out to just a touch under 17 million contracts a day. So there are a lot of you using options because they are dynamite financial tools that give us the ability to generate risk and, protect our portfolios. I'm not really going to get into what options are tonight. We're really going to just talk about the strategies. So I think, as Nick had said in the description, it's a little bit more geared towards intermediate tonight than the beginner level. With that in mind, again, always a focus with any investment, risk versus reward. And tonight we're going to talk about covered calls and cash secured puts. If you notice, I have them on the same line. They have a lot of similarities, which we'll get into in just a minute. Straddles and strangles, quite similar as well. We'll talk about time spreads, diagonal spreads, the 4 type of vertical spreads, and we'll wrap it up with covered combos. So let's start right here. Covered calls and cash secured puts. This is the risk profile of both strategies. They're exactly the same. You may or may not realize that. But a covered call and a cash secured put are exactly the same strategies from a risk profile standpoint. Okay? Covered call has substantial risk on the long stock position. The break-even point is the stock price paid minus the call premium received. On the cash secured put side, the risk, as you can see, is very substantial as well. That break-even point is going to be the strike minus the premium received. We'll get into examples on both. But I know, in talking to investors across the country, oftentimes what do you mean a covered call and a cash secured put are essentially the same thing? Well, they are. And, the dotted line on the slide here represents, a stock position, a long stock position, making money to the upside, losing money to the downside. And that solid black line represents the covered call and the cash secured put. You can see they're identical. As I say, we'll get into examples to explain why they are identical. For those of you who don't know, the covered call is when an investor buys the underlying and sells or writes one contract for each 100 shares that they buy or own. If you do it at the same time, where you buy the stock and sell the call, the terminology is covered right or buy right. If you happen to have the stock in your portfolio and then you decide at some point just to sell a call, the terminology there is overwrite. But more than anything, that's semantics. Covered calls, you own the underlying stock and you sell one call for each 100 shares of the underlying you own. That's covered calls. With regards to the call obligation or the writer, we know we receive the premium for taking on the obligation, whether we're assigned or not. Assignment is when you have to deliver the short stock at expiration. The long call buyer exercises the call. The short call seller has to deliver the short stock, but that short stock is going to be offset by the long stock that you had to buy when you purchased the covered call position. Upside profit potential with the covered call, like that first slide showed, is limited. And it's limited because we take on an obligation by selling a call at the strike. We have to sell the stock at that strike price plus whatever premium is taken in for the price of that call. In terms of our loss potential, it is significant. Just think big picture. And we'll go through an example. The risk comes in, if you take in $1 or $2 by selling a call, after the stock goes down, $1 or $2, after the stock declines more than the premium taken in for the sale of that call, you've got nothing but long stock, so therefore substantial risk. So as I mentioned, let's take a look at an example. We've got XYZ, certainly our favorite stock. It's currently trading at 43.50. We can see the range for the years between 36 and change and just under $50. We've got a forecast, and that's important, with any investment. You have an opinion on whether things are going up, going down, and, we put on positions accordingly. Our forecast is that XYZ will trade between 45 and 50 over the next 80 days. Pretty specific forecast, but seemingly reasonable inside of the 52-week range with a current price of 43.50. So our action with the covered call, of course, we have to buy at least 100 shares of the underlying at 43.50, and then we decide to sell the October 45 call, and we get $2.30 for taking on the obligation to sell stock at 45 or higher between now and October expiration. And October expiration is in 80 days. So we're buying 100 shares of stock at 43.50 and selling a call 80 days out into the future and collecting $2.30. Basically one key difference here, third bullet, important information. I mentioned expiration's 80 days out, but XYZ pays an 18-cent dividend, and that happens in 27 days. And why is that important? And we'll go through some return examples. But that's important because we own 100 shares of stock. If that dividend was far closer to expiration, and depending on the price of the stock, we might have assignment risk. With so much time still due until expiration, we know that we don't have assignment risk with that 18-cent dividend. So in addition to owning the 100 shares at 43.50, this position will pay us 18 cents for each share of stock we own. So that's how it looks, similar to that initial chart where we showed the covered call risk-reward profile right next to the cash-secured put. Dotted line represents the stock. That solid line represents the covered call. You can see it flattens out horizontally above 45 because we have taken in the $230 and taken on the obligation to sell stock at 45 at expiration or sooner if exercised earlier. Now let's just think again kind of conceptually in terms of what is our break even. You can see that the solid black line, the break even point is to the left of the 43.50 point, and that's just because the $2.30 we take in as premium lowers our break even point. So the stock price was 43.50. We take that stock price minus the premium we take in, so it's the 43.50 minus the $2.30 gets us to a break-even point with this covered call over the next 80 days at 41.20. Maximum profit, on the other hand, is going to be the difference between the price that we bought the stock, the strike price, and then the premium that we took in. So it's the 43.50 that we paid. We take the strike price, which was 45. That's the obligation we took on to sell stock at 45 or higher out in October. So it's the 45 minus the price of the stock we paid plus the $2.30 gives us a maximum potential profit of $3.80, or each contract corresponds to 100 shares of the underlying. So the maximum profit for each time we do this is $380 minus commissions. So here's our example in kind of a graph form that will show different stock prices. 43.50 is where we bought the stock. If the stock at expiration, and that's what this chart's showing us, at expiration, if the stock is still 43.50, well, we didn't lose any money on the stock, and we took in that $230 in the call minus any commissions. So we're a winner there. One of the focuses tonight is risk reward. Always, try to focus on your risk before you focus on your reward, because you want to be aware of any worst case scenario. We know with the covered call and the cash secured put, the worst case scenario is if the stock tanks, because at some point you're just long stock, so that's where the risk is. So you can see below 40, 35, and 30, if you go out to the right-hand side, the risk becomes very substantial. We talked about a break-even point with this covered call position at 41.20. So at $40 at expiration, far right-hand column, we can see we lost $120. Down $5 would be an additional $500 loss because, again, below 41.20, we are just flat out long stock. And of course, at 30, we'd be down another $500. So you're not putting on covered call or cash secured put positions when you think a stock's going to tank. And then to the upside, we went through this in a little different way. At 45, we'd have made $1.50 with the increase in the stock price. At 45, we got to sell that call for $2.30. So at 45, it is worthless, or it has no value. You might get assigned if the stock went out right at the strike, which means you'd have to deliver the stock. But you would have a combination of the $1.50 profit plus the $2.30 profit from the option for a maximum profit of $380. And if the stock went to 50, 55, or infinity for all that matter, the stock maximum, or excuse me, the position maximum profit would stay the same at $3 or $380 because we sold the obligation to sell stock at $45. So that's the covered call example. I hope that's making sense to you in terms of the risk and potential rewards. Let's go through quickly two types of returns. Okay, we've got the static return for a covered call, and then we'll have the if called return. So the static return is just as the name suggests. The stock doesn't move. There's the formula, which, if you're interested in that, you can, as Nick said, check out the presentation online on the YouTube channel afterwards. But, when we get down to the nuts and bolts, how to figure out the income versus the risk, we took in $230 by selling the call. We take in an 18-cent dividend for each share of stock we own. Total income, $248. We divide that by the stock price, and that gives us income at 5.7% over those 80 days to expiration. If we take those 80 days and divide it by total calendar days of 365, that would give us the chance potentially to do this same strategy 4.5 times. That's unlikely to happen because the premiums, for those of us who are in the options market know, premiums do fluctuate. And so as they fluctuate, maybe in one 80-day period you get $2.30. Maybe in another one you might only get $180 or $1.80. But on the flip side, if premiums were higher, maybe you could get more than $2.30 as well. But if we were able to do the same position each time we rolled off, it would give us a chance to do it 4.5 times over the course of the year. And if we take that 5.7% and annualize it, it comes out to a whopping 26%. But more importantly is understanding the whole concept of what a covered call is. Long the stock, short the call. Kind of the most important thing in my mind is picking the month and the strike where you have the obligation to sell the stock. And of course, the month may depend on corporate actions, when are earnings, things like that. And the strike choice is going to depend on your opinion of the underlying. So that's really, to me, where the rubber hits the road. The other type of return formula is if called. Okay, so static, we know the stock didn't move. If called is just that. We're selling a call. We have an obligation. If we're called away, if we're assigned, that means that the stock has closed at expiration through the strike price, so we are going to be assigned and called away. So let's take a look at the worksheet here. We take in the $2.30 for selling the call. We add the 18-cent dividend. But here's the difference, okay? And this is where strike price selection comes in and is so important. If you sell an at-the-money call where the stock and the strike are the same, you don't have any potential profit from the stock going higher. We bought stock at $43.50 and we sold a call $1.50 out of the money. That 45 call terminology, for those just new to options, the call price is above the stock price, so the terminology is it's out of the money. If we are called, clearly the stock would have gone from the 43.50 price through the 45 call strike, so we get a chance to make another $150 because the stock went up to the strike. So that's what we mean by if called returns. So instead of, the 248, we get total income of 398, which of course is going to increase our returns. We divide that by the price of the stock. It comes out to 9% and change. Again, if we're able to do it 4.5 times over the course of the year, we have a whopping return in this example. But static return, stock doesn't move, or at least doesn't move above the strike, and then if called return, when the stock does appreciate, you get to add that additional income to your calculation. So that's how it works. This slide I actually already went through, so I don't think I need to repeat that. That's covered call, and I hope that's clear to you. Let's quickly go through cash secured put. Cash secured put is basically a position where we sell a put, which gives us the obligation to potentially have to buy the stock. Put seller's obligation is to buy the stock. Call seller's obligation is to sell the stock. So put sellers are looking to acquire the stock at or below the strike price that they choose. Getting back to this idea that picking a strike price in a month is really the important thing in options and also the most challenging. So just to be clear, when we sell a put, our potential obligation is to buy the stock at or below the strike price. But of course, if we're taking on the obligation, what do we get? We get cash. We get whatever the premium was for the value of that put. Of course, the risk potential is substantial, just like the covered call. At some point, if we take on the long stock, that's our position. We are flat out long stock, so we have, the risk that any long stock position would take on. And that's the picture. Profit potential is limited, and of course there is substantial risk. Why is the profit potential limited? What have we done? We have sold an option. We've sold it for X price. We can't make any more than whatever we sell the option for. So if we sell it for $1, the most we can make is $1. If we sell it for $10, that's the most we can make. We know our maximum profit or maximum loss is going to be in the short cash secured put is going to be the strike price we sold minus the premium we took in, whatever that break-even point, between that point and zero is the substantial risk that is taken on with the cash secured put. So, as I mentioned, it's the same kind of risk that a stockholder would take on, depending on, where you sell the put and the price of the stock at expiration. You may or may not get assigned, and you may or may not have a profit. Let's look at an example just to kind of give us an idea. If we sell the XYZ 50 put at $3.80, if we sell it at $3.80, the way we figure out our break-even point is 50 minus the 380. So we're actually potentially buying the stock at $46.20 because it's that 50 strike minus the 380 we take in. So $46.20 is our break-even point. Now, if the stock at expiration is above 50, how much money do you think we're going to make if we sold the put at 380? I hope you said 380 because the put with the stock above 50 has no value at expiration. So we'd have taken in all of that $380 or $380 at expiration. If the stock closes at expiration anywhere between $46.20 and $50, anywhere between $46.20 and $50, we are making a profit, but we're going to be assigned, meaning we are going to have to take on our obligation, which means we're going to be long stock at expiration. As an example, if the stock closed at 48, what would the value of that put be at expiration? The stock closes at 48, that 50 put is going to be worth $2. We sold it for $3.80, so we'd have $1.80 of profit, and then it's up to us to decide whether we're going to sell the stock, whether we're going to hold the stock. There are different choices for another webinar, I guess. But the short put allows us to either take in premium if our goal is just to do that, to take in the premium, or to potentially buy stock if the stock is below the strike at expiration. You do have to really be comfortable with owning the shares of stock at your break-even point below that short put strike. So you got to be ready for that. You don't want surprises. Are you comfortable owning those shares of stock? Can you buy those shares of stock? Cash secured put means you put the capital in the account to be able to buy that stock when the stock closes below the strike at expiration. You're going to take on delivery of that stock. And depending on the price of the stock, in our example, if it were above 46.20, you'd have made some money. Below 46.20, you'd be out some money. And that's really what you really need to consider both for the covered call and the cash secured put. The risk is the long stock, and both positions have exactly the same risk profiles. So let's move on to the next two, long straddle and strangle. Okay, you can see the first word there is long, which means we own options. Long positions, you buy options. Short positions, you short options. A long straddle is when we buy a call and a put. Of course, same underlying, stock index or ETF. Same strike price, same expiration month. That's a straddle. So you can see the little P&L graph to the right. And really the motivations are two. One, to take advantage of increased volatility. Well, why do we care about increased volatility? Well, that's because when volatility increases, option prices, their premiums go up. The call and the put will both go up in relation to one another. So truly the motivation for a long straddle is the potential to make significant money when you have an increase in implied volatility. So those premiums in both the call and put go up, and that whole relationship between the stock, the long put, and the short call is the whole idea of put-call parity. That's why the call and the put both go up at the same time. And, of course, the other motivation is if you're expecting a big-time move up or down in the underlying, a long straddle, because you're long a call and long a put at the same strike can make you money there too. But, depending on how much you pay for that straddle, it may have to move quite a bit. Let's take a look at an example, and I just look at the one number, 620 debit. We're buying a call. In this example, the Jan 50 call. We're buying the Jan 50 put. We get two prices. Total debit is $6.20. So we're paying $620 for the 50 strike in XYZ. Let's take a look at how we look now. The strike is 50. So notice we've got 56.20 and 43.80 popping up. Why do you think they'd be the numbers to pop up? Because they're each the distance from the strike. There are break-even points. Okay, so it's the 50 call plus the 620 takes us to 56.20 as a break-even point. Above 56.20, we're in the money in this straddle. And then on the downside, it's the 50 strike minus the 620 takes us to a 43.80 break-even point. So at expiration, anywhere in between there, we're losing. And you sure hope if you buy the at-the-money straddle, in this example, it's the 50 straddle, you sure don't want that stock to go out at the straddle at expiration, because as you can see, you lose all of your debit that you paid for this straddle. So you either need an increase in implied volatility or the stock to move. Now, it's not to say that when we buy straddles and strangles, or any position for that matter, that we necessarily hold it to expiration, but at expiration, this is how it looks. And then above 56.20 and below 43.80, we take the box takes us to 40 and 60. We're making $380. It would be another $5 at 65. So at 65, we'd be up $880, and at 35, we'd be up $880 as well, and so on and so forth, because we're long the call and we're long the put. Obviously, at $35, it's the 50 put that's worth a lot of money, where the 50 call is not going to be worth anything. So that's the long straddle, and this is the P&L graph, and this is how significant the premium potential and that theta risk is. You can see that's a big area below the break-even line. You're buying a call, buying a put. So that stock better rock and roll and move, or that implied volatility, better go up. If that stock just dies and starts sitting around, depending on how many days to expiration, you can multiply or divide those days by the $620 and get some idea of how much theta or how much decay both that call and that put are going to take on each day. But, oftentimes as you go out in time, implied volatilities can be lower than front month. It's not uncommon for more advanced traders to buy straddles out in time and then sell front month options against that. And one of the strategies we'll just briefly touch on, the diagonals, can be a form of that. So that's the long straddle example. Notice the difference with the P&L chart to the long strangle. And how do you like the lingo in our options business? Straddles, strangles, Christmas trees, condors, butterflies. It is a different language. Try not to be intimidated by it, or it is confusing, but really the concepts, if you just take the time to study what these crazy names mean, it's really not bad. The strangle is similar to the straddle in that you're long a call and you're long a put. But notice, the worst case scenario from a P&L standpoint is a horizontal line, not a V-shaped line. The difference being we're buying an out-of-money call and an out-of-the-money put. So we're going to pay less because we're buying out-of-the-money options. But, in the end, we're long a call and long a put for each straddle or strangle. So it's the same motivation we're looking for in terms of potentially making profit. Increased implied volatility, higher premiums, of course, are going to help the calls and the puts, and then a big move in the stock is going to help as well. So that's the strangle. Same $50 stock, XYZ, but again, we're talking about buying out-of-the-money calls. $55 call, we pay $1.40 for that, and the 45 put, pay a little over $1 there. So instead of trading or paying $6.20 for the at-the-money straddle, we pay less than half that for the strangle. And in this example, it's the out-of-the-money call and the out-of-the-money put, both $5 out of the money. We pay $2.45 plus commissions. So here's how it looks. I think you probably can get a pretty good sense of that. We take our strike prices and add the premiums to the strike prices, or subtract, depending on whether it's the call or the put. So on the high side, we're long the 55 call. We take that 55 call and add the 245. So our break even, as you see, is $57.45. To the downside, we've got that 45 put that we're long. We subtract the total premium of 245, takes us to a break even of 42.55. Anywhere in between those numbers, at expiration, we lose all our premium. Okay, so that's a far wider range than that $50 number on the $50 at the money straddle. Okay, and then above 47.45 and below the 42.55, at 40 and 60, we're making $255, so more than doubling our money. And of course, we'd be making point for point as the stock goes up or drops, goes up above 60 or drops below 40, it's a point-for-point gain because at that point those options are pretty deep in the money. So, here it is just in P&L form. And again, always try to understand and ask the question, where's my risk? What's the worst case scenario? Know your break-even points rather than that big triangle and loss below 50 in the straddle. We have a far lower loss, but a little wider break-even point with the strangle. So that's straddles and strangles. Again, on the straddle side, you got a higher cost and generally a little bit lower leverage. Break-even points are closer together, but as you can see, it depends. Sometimes not that much different. Less chance to lose 100%, and that's because it's fairly unlikely that the stock is going to, close right at your long strike, unless you're like me, and it always closes at my long strike. But well, not always, but it's been known to. But hopefully, you trade out of those positions or you offset some of the decay risk in advance of losing your investment. Strangles, on the other hand, lower cost basis, and you do have the higher leverage. Break-even points are further apart, and because they are further apart, there is a greater chance, to lose all of your premium. But that's if you take it all the way to expiration. Most option positions, in excess of 70% are generally closed prior to expiration. And that third bullet, the big bullet there at the bottom, that's the takeaway on straddles and strangles. Time decay is painful. You need a big move in the stock or an increase in the implied volatility. You're long a call and a put. It's a luxury. You've got gamma. Stock goes up, you're getting longer. Stock goes down, you're getting shorter. We'd all like that. But the cost of those positions is time decay. So if you trade volatility or have an opinion on volatility, taking a look at straddles and strangles can be a useful approach. Let's roll over to the time spread. When I was on the floor for all those years, time spread, very conservative strategy. Actually was one of my favorites, certainly back in the early days. So what is a time spread or a horizontal spread? It is all calls or puts. You generally sell one of the front month options and then buy another option in the same strike, always the same strike, a little further out. And because you're buying time, these spreads are always a debit. And actually, you can do time spreads where they're bullish, bearish, or neutral, depending on the price of the stock versus the strike where you put on the position. So, if you do an at the money, so we'll go back to XYZ, say it's $50. If you do if your expectations for the stock just to lay around and not move a whole heck of a lot at the $50 range, your opinion would be neutral on the stock. So you purchase the $50 call spread. You sell some front month or front week, and then buy further out in time, and it's always a debit. So because you are buying time. Hard to calculate exactly what the maximum profit is going to be, because as you get to expiration, you may know what the front month option is, but it's you can't know in advance what the implied volatility levels will be in that further out month option. So knowing exactly what your maximum profit potential is really not possible. Now, your maximum loss, and going back to the whole idea of risk-reward, your loss potential, because the loss potential right out of the box is the debit you pay for that spread. So if you pay $1.25 for the $50 time spread, the most you can lose is that $125. And let's hope, if the stock goes against you, you get out of it before, you lose the whole $125. But the goal is, as you get to expiration, that front month option has decayed more than the decay in that further out option. So hopefully that spread that you paid $1.25 for, is out to maybe, 150 or 175, depending on the price of the stock. That's the goal. And the best way really to learn about these time spreads, go to your favorite, 2 or 3 stocks and look at the value of the time spreads. Consider the month that has earnings. See whether those implied vols are higher or not. And look at those time spreads over a couple expiration cycles and just see, whether the debits are consistent or if they change. If they change, it means that chances are it's a stock that has some volatility, and it means that the implied volatility levels do change. The second bullet here in this next slide talks about the potential for assignment risk. Back to XYZ $50 stock. If we've held this position very close to expiration and the stock's 51, let's say it's expiration day, and we're expecting to be assigned. If the stock goes out in the money, we would be assigned. So you typically want to unwind that spread before you get assigned, because if you get assigned, you're then going to be short stock versus a long call, and you'll have some risk in that position that is not what you were after when you first put on the time spread. So assignment risk, knowing where the price of the stock is versus the strike at expiration, is the area that you need to manage. Let's see. There we go. Let me go back to that. Took a little while to jump up there. An example. We've got XYZ at $60. We're neutral on the underlying. We buy the 60-day 60 call and sell the 30-day 60 call as well. Bottom line, we're paying $1.25 for this spread, and the idea as we get to expiration is that 60 call, that 60-day 60 call, will have more than $1.25 of value as we get to expiration, and that's when we make money. If the stock is, and you can see this next graph, which speaks to the heart of P&L, our maximum profit potential is when the stock is just below 60 at expiration, because that short month option will go out with no value, and right there at 60, that next month option should have its maximum value. Now, again, you get into the whole idea of implied volatility. If the implieds have gone up, there will be even more premium in that option. If implieds have come down, you stand the potential for that option to maybe even be priced below that $1.25 that you paid for it earlier. In terms of, I talked about at expiration and the possibility for being assigned. You have to be aware of that if the stock is above 60 at expiration. The thing you really want to do generally is just close out the position. I talked about bullish, bearish, and neutral time spreads. The way we approach that in our $60 example, if we thought the stock was going to lay around at 60, we do the 60 strike. We're neutral. We do the at the money. But if we're bullish enough where we think that stock may run up to the 65 level or some higher strike than the at the money, that's when we do a higher strike time spread because we're looking for the stock to approach that short strike. That's the key with time spreads. You want that underlying position to try to go right to the or be just shy of the strike price at expiration. That's the target. And then if you're bearish, you can either do an out-of-the-money put spread or you can do a lower price call spread. The risk there, if you do a lower price call spread, it'll be in the money and you stand a better chance of being assigned. So, turning around and doing that out-of-the-money put spread as the stock goes down to that lower strike, you'll get an expansion in the value of those two options. So that's how the whole idea of time spreads work. Basically, you're selling the near term and buying further out. You can do them neutral, bullish, or bearish, depending on your opinion of the underlying, and then you choose the appropriate strike. And as I mentioned earlier, Maximum profit can be challenging to figure out. You really won't figure out exactly what that maximum profit potential can be, but the maximum loss you do know going in because it's the debit you paid for that spread. So that's time spreads. A couple more here. Diagonals, and I'll just touch on that real quickly. Basically, you buy a longer-term call with a lower strike. In our example, we've got June and July calls. So you buy the July 50 and sell the June 55. Now, depending on the price of the stock, if it's closer to 50, that 55 is going to have a lot less premium. If it's closer to 55, it'll have far more premium. So there are certainly, like most option positions, there are nuances depending on the combination of strikes that you want to employ. Will have something to do with your opinion on the underlying, but a diagonal is just as the name suggests. You're buying 1 month on the call side. It's a lower price call, and then selling a closer to expiration, typically at or out of the money call. That is your diagonal spread. And the idea is basically always to do just calls or puts, different strikes, different expirations. That's a diagonal. Motivation really is to take advantage of the different rates of time decay. In our example, the 50 call is going to have less time premium, where the 55 call, if it's out of the money, will be all time premium. So you're hoping that that time premium decay coming to expiration offsets any loss in that deeper in the money call. And really these diagonals, and I just throw them out there to make you aware of them, it really is a hybrid of the vertical and time spreads. Speaking of verticals, we've got 4 of them. We'll go through them quickly before we cover the covered combination and then go to questions with Nick. For those of you who don't know vertical spreads, a vertical is when you buy one option, sell another, all calls or puts, different strike, same expiration, always same underlying. The different types, we've got bullish spreads with calls or puts, and we've got bearish spreads with all calls and all puts. So risk versus reward, that's why these spreads, I think are pretty dynamite. They can get a little challenging to manage as you get close to expiration because the delta in some of the options. But from a risk-reward standpoint, just like the, most spreads that you're doing for a debit, the most you can lose is the debit you pay. And the difference about a vertical spread, the maximum profit can be defined right at the outset. So the maximum profit is going to be the difference between your strikes, whether there's a $1 difference between the strikes, a $5 difference, a $10 difference, whatever, minus the debit you pay. That's your maximum profit. So that's one of the nice things about vertical spreads. You know your risk going in. You also know your maximum profit potential if things go your way. These spreads can be done for debits or credits, and I mentioned the maximum value. So let's go through the 4 types of vertical spreads. We've got the bull call spread. Bull meaning, we have a strong opinion on an underlying. We think it's going up. You buy one call, sell another. You can see the P&L graph suggesting, you make money as the stock goes up, but then, the line goes horizontal at the strike we've sold, and also to the downside. You've got maximum loss, and that's the debit you paid for this spread. With the calls, you always buy the lower strike call, and that means when we're buying the lower strike call, these spreads will always be put on for a debit. Quick example, we got the 60-70 call spread. Let me back it up just in terms of our forecast on XYZ, which is trading at $63. We got a forecast that the stock is going to go up by about 10%. So we've got all kinds of different strike prices to choose. But if we're looking at a 10% appreciation in the underlying, you take the 63 times 10%, it's about $6 on top of 63, takes us to 70. So that's why in our example, we're long the 60 call, and we've shorted the 70 call. As is the case with most option positions, you want the stock to be at your short strike at expiration. So if we only thought the stock was going up 5% or less, maybe we would have done the 60-65 call spread. But we think this stock's going to have a good run. So we can make a heck of a lot of money with the stock going from 63 to 70 with the 60-70 call spread, and our risk is $3.50 because that's a debit we've paid. Let's take a look at the chart that shows us how we're making money and how we're losing money. And there we are at 63.50. That comes up again because that's our break-even point. We take that strike that we're long, the 60 strike, we add the debit we've paid, 350, takes us to 63.50, which is our break-even. To the downside, again, we're bullish. We're looking for the stock to go up. If the stock goes down, we expect to lose money because we're wrong. The stock went down to 60 or below, all the options would expire with no value, so we would have lost all of our $350 or $350. The stock went out at 61. The value of that call spread would have been $1 because the 60 calls would have been worth $1. At 62, the spread's worth $2 because the 60 call is worth $2, where the 70 call is worth nothing. So we'd have smaller losses between 63.50 and 60. Below 60, we've lost the entire commitment to the spread. And then to the upside, simple math, we're essentially long the 60 call, short the 70 call. Anywhere between 63.50 and 70, we're making point for point with the stock. Above 70, we can't make any more because the difference between the strikes is 10. We paid $350. Our maximum profit is $650 or $650, whether that stock's $70 or $170. So I hope you understand that. And if not, we've got lots of information on our website about vertical spreads. The bear call spread, okay? We just went through the bull call spread. The bear call spread is, a bearish position. We're looking for the underlying to go down. Same core way that this thing is created. You buy one call, sell another, but you sell the call with the lower strike rather than buying it. Same expiration, same underlying, always a credit spread because we're selling a lower strike call, which means it's going to have more value than the higher strike calls. So that's why we always do this thing for a credit. Turn that same spread around. Rather than being bullish on the underlying, we're neutral to bearish. So we sell the 60 call, buy the 70 call. The most we can make is the premium we take in, which is the 350. We can lose up to 650 because if we were dead wrong in our bearish opinion and the stock went 70 or higher, we could lose the difference between the strikes minus the credit we took in. That's what this box will show. Downside, profit potential, upside, maximum loss. And again, no matter what option strategy, try to go through that scenario in your head. And, that's how it looks, in a little different way. You can see there's a lot more downside than there is profit potential because the difference between the strikes is 10. We've sold that spread for 350, so we've got a full 650 of risk, but our opinion is, the stock's going down. Two more vertical spreads. The bear put spread. Okay, bear put spread. Puts, basically you buy puts, you're looking for the stock to go down. The bear put spread is just that. We're buying, a put with the higher strike, selling the lower strike put. So we're buying the one that has more value. Therefore, the bear put spread is always a debit spread. In our example, we got a $39 stock, looking for the stock to decline maybe 10%. You take a $39, $40 stock times 10%. That gives us a target around $35. That's why we chose the 40-35 put spread. We always want our option, expiring options, we want the underlying to go to those short strikes for our expiring option positions, and 35 would be the target. So if we pay $1.50, We know the most we can make is 350, the difference between those strikes minus the 150 we paid, and of course the most we can lose is the 150 we paid. And that's just another way to look at it right there. And lastly, we've got the bull put spread. So the bull put spread means that we're going to sell the higher strike put and buy the lower strike put because our forecast is for the underlying to go up. Again, same strike, same month, same expiration. Take that same $39 stock, but we're either neutral or bullish here. We take in the $1.50 credit. We know that's the most we can make, the most we can lose. If we're wrong and the stock goes to 35 or lower at expiration, would be that full 350. And that is just the other way to look at that P&L with the vertical spread. And lastly, before I roll it over to you, Nick, covered combos. I'm not sure how many of our listeners are familiar with covered combos. They have quite a bit of risk, okay? It is a covered call. So you own 100 shares of the underlying, and you can see you write or sell one call, but on top of that, you sell a put too. So you're selling two premiums, and you have 100 shares of long stock. So it's really like two bullish positions. We take a quick example. We got a $52 stock. We sell that out of the money 55 strike call and the out of the money 45 strike put. That would be a covered combo. And basically, a couple different motivations. We're selling the put, so we may, like, the underlying at the current price, and essentially we do a covered call there. But by selling the put, if the stock goes lower, we have the potential to buy the stock at that discounted lower strike price, or just take in premium, whatever we sold that put for, if the stock in fact doesn't decline, to that lower strike. So in essence, you're getting paid to wait for the stock to drop on top of a covered call position. Biggest risk in a covered combo, it really is those two risks. It's the long stock and it's the potential short put. So you just need to be aware of that, and you can see that's a awful significant downside P&L graph, and that's because we've got two potential long positions. We got the covered call, which is protected by the premium we take in on the short calls we've sold, and then we've got the short put, which is just a long stock position at the break-even point of the strike price minus the premium we took in for that long stock, for that short put. So two long positions. But that's covered combo. In a bull market, that has worked for a lot of investors, but as you can imagine, it's also a position that takes a lot of capital because it is two long positions. So with that, Nick, I'll just turn it over to you. I think folks know that we've got the MyPath assessment test online, which will give you lessons to download at your leisure. We have our great group at Investor Services that can be reached at 888 Options. And just to reiterate the two things you said at the top, Nick, we've got new survey questions, 3 new survey questions. Please take a look at them if you don't mind. And then also our evening seminar schedule is posted on the website now for folks in those 5 cities that Nick talked about. So, Nick, I'll turn it over to you.
Joe, thanks again for all your help. This is fantastic stuff. And we do have a few questions today, but since we are a little short on time, I want to reiterate to our listeners that if you do have further questions about the concepts we discussed or any of the tools on the OIC website or any option strategies you're thinking about deploying, or if we're not able to get to that question that you submitted via the chat, you can call the Investor Services team at 888 Options. They're available during normal business hours, ready to help answer your questions about strategies or positions. Additionally, today's session will be archived and accessible in a few hours using the same link you used to join us today, as well as available on the OIC YouTube channel, so you can review a number of option strategies at your own pace. Joe, got a couple of great questions from some very astute listeners today, and the first one is, this investor has put on a bull put spread and it went bad. What are the best choices for exiting with the least amount of loss?
Well, it starts with your discipline. you clearly had an opinion that the underlying was going up. And that's based on who knows what factors. For me personally, I was always, and I'm a chart person, so in my mind, when I put on a position, I have a level in the stock chart or the index chart, ETF chart, where clearly if it's going the other way, I was wrong, and that's where I get out. So to me, it goes back to charting analysis. I have my own break-even point based on the action of the stock, and I go from there. There is another approach. This is not the way I typically do things, but you put on, a bull put spread for, X dollars. Maybe you are driven by, the dollar amount, and trading based on dollar amounts can be a really good way to trade. I mean, there are a lot of different things, a lot of different strategies that I'll approach that way. Let's just say, you sold the put spread for $1.50. If that spread goes to, beyond your threshold, whether that's $2, $2.50, everybody's got a different threshold for pain, but maybe it's driven by, the value of that spread going against you in some measure, to find that measure and then get out at that point. So two different choices, Nick, from my perspective.
Joe, we got a number of questions about what market factors would be best to use the different strategies for. For example, what spread strategies are best to use when volatility is high? Or could you talk about what market conditions might be better for other approaches?
Okay, vols, and it's a great question because, vols drive, and when I say vols, I'm talking about implied volatility levels. Those implied volatility levels drive how much premium, whether it's large level or small level, in your option prices. So we went through lots of different choices today. In covered calls or cash secured puts, what are we doing? We're selling options. So on the option sell side, we're looking for higher implieds, ideally. It's not to say that you go into a strategy because of the level of the implied, but you pick your strategy because you believe in it, you're comfortable with it, and then you analyze implied volatility levels. So when you're selling options, the hope is that the implied volatility levels, the premium levels, are elevated. And then on the flip side, when you're buying options, you hope that the implied volatilities are, to the lower levels. And you can check the implied volatilities just like you can any chart stock at optionseducation.org under Tools and Resources. Look for the historic and implied volatility charts. You'll find them on the right-hand side when the page pops up. Just hit those little thumbnail charts, and you'll see the great, historic over implied volatility charts. And one other thing, Nick, the vertical spreads, because you're buying basically same month, different strikes. Implied volatility is not a huge factor in the in the vertical spread strategies because you're buying one option and selling another.
Joe, for a covered call, when you have 100 shares of the underlying, why is there unlimited risk with the selling of that call?
Well, the risk is the value of the stock going to zero. So it's not unlimited, but it is the stock going to zero. So quick example, $50 stock, we sell an at-the-money call for $3. So we take the price of the stock 50, or the strike 50, and the price of the stock is also 50. So it's the 50 minus the $3 of premium we take in. Our break-even point is then $47. Anything between 47 and 0 is the risk in that position. So that's the risk in the covered calls and cash secured puts. The stock price below your break-even point going to 0.
Joe, since we are a little bit over time, we have time for one last question here, and I'll try to make it as general as possible for a number of our listeners. Do you, Joe Burgoyne, prefer straddles or strangles, and what would be best for, say, an options investor who's just getting started?
Well, for an options investor who's just getting started, I would be careful with straddles and strangles a little bit because you're buying calls and buying puts, okay? For somebody getting started, if you're going to get into the spreads, I like the idea of buying one option, selling another, because you have a little bit of a hedge. There's less risk. But back to the question, I typically, not always, but more typically, would buy Strangles because you tie up less capital, and I then trade different options around that Strangle. So, my core position is, maybe 3 months out in time, buying an out-of-the-money call, out-of-the-money put, and then selling, depending on my opinion of the underlying, selling maybe the front month at-the-money calls. And that, in essence, gets into, your butterflies and things like that, but they're not the same month. So I will typically lean towards the Strangle and then sell front-month options against it.
Joe, do you have any closing comments for our listeners today?
No, Nick, just as I said at the top, I love talking about the strategies. Hope I didn't try to jam too many in today. If you think I did, let me know in the comments, please. And thanks for joining us.
Ladies and gentlemen, thank you very much for your time this afternoon. While we weren't able to get to all of your questions, we have our investor services desk ready to help at 1-888-OPTIONS. Feel free to reach out to them. Many of you in the questions asked about further education. Please visit optionseducation.org, the OIC's website, and see the Getting Started section for further reading. Again, today's session will be archived and accessible in a few hours using the same link you used to join us today, and our webinars are available on the OIC YouTube channel, so you can review a number of options, strategies, and concepts at your own pace. And, of course, make sure to check optionseducation.org in the upcoming weeks for our 2015 sessions. Our next webinar will be held on August 4th, and we'll be discussing contract adjustments. If you're in the New York, Chicago, Boston, Dallas, or Los Angeles areas, please come to one of the OIC's evening seminars this fall. The full schedule is available on the website, and our season kicks off on September 16th in Chicago. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.